Hello, everyone. We are very pleased to welcome you to this webinar organized by Carbon for Finance on how to anticipate climate risk with data. We had almost 500 registrations to this webinar. Thanks for your enthusiasm. And we hope that the presentation will meet your expectation. And we will try to leave enough time after the presentation to answer your questions. To start, I am Marianne Vincent. I recently joined Carbon for Finance as Head of Business Development after spending 15 years in the banking industry at various positions. I will be introducing this webinar and then leave the scene to the very well-known Jean-Marc Jancovici, founder partner of the group Carbon 4 and president of the think tank The Shift Project. We also have with us today Jean-Yves Wilmotte, leader of the finance practice at Carbon 4. Jean-Yves is a member of various work groups such as the IMF Climate and Sustainable Finance Commission and the European Technical Expert Group on Sustainable Finance, the TEG. Why did we want to organize this first webinar? Well, the COVID crisis and its cascading worldwide impacts warn us that we are definitely not prepared to the unexpected. And the crisis has shown that the interconnection between extra financial and financial risks is more decisive than ever to build the next world. So regarding climate change, we are aware that the world will face brutal consequences in the near future, and companies and institutions definitely need to go beyond short-term management in order to ensure sustainable performance and resilience of their activity. With accurate climate data, investors are able to identify the companies that contribute positively to the climate transition, and these companies are generally better prepared to face this type of crisis because they position themselves on the most relevant markets and technologies in the long term. I now leave the mic to Jean-Marc, who will explain how to anticipate climate change impacts.
And we can also emit other gases than CO2, one of them being methane, which is emitted either through looking for fossil fuels or through cattle raising or rice paddies. What you can see here is that the overall emissions have not been halted at all or even slowed down by either climate talks or by dematerializing the economy. Actually, both these processes, climate talks and the IT boom, and even the renewable boom, have not altered the growth of greenhouse gases emissions so far. So actually, it's probably things that do not play a major role right now in the world. One of the reasons why we emit greenhouse gases is because we use energy. Here you have the energy used for the last century and a half also. What you can see is that we have piled one on the other all the forms of energy that we could find on Earth. First, we used wood, then we used coal, then oil, then gas, hydro, nuclear, and this is new renewables. And you can see that for the time being, they remain marginal in the world supply. Most of the world supply is constituted of fossil fuels. And even during the last years, fossil fuels have contributed to most of the increase of energy use. Why do we use energy? Well, actually, we use energy to become Superman. That's basically what we use energy for. Energy is used to fuel machines, and those machines we are using in order to multiply the power of our own muscles by astonishing numbers. Basically, energy is enabling us to fuel or to power parts of an Iron Man costume constituted of all the machines that we can find on Earth. And the cumulated power of all the machines that we fuel with energy has led to the multiplication by 200 on average on Earth of the power of our own muscles. In other words, if machines, thus energy, didn't exist or wasn't used on Earth, the productivity of humanity would be divided by 200. So the economic production of humanity would be divided by 200. So energy is the blood of our industrial societies, of our modern societies, even for those that boast to be dematerialized because services are occupying 70 or 80% of the active workforce. If we look at the Western world, the multiplier is not 200, it's close to 600 or 700. which means that without energy, actually, the world and the economy collapses. Not the world, but the economy collapses. And energy is a limiting factor for the world production. You can find here a curve, which is the logical conclusion of what I've just said. I've plotted the world GDP on the vertical axis against the world use of energy, that is the world fleet of active machines for the last 60 years. And what you can see is that globally, GDP is a linear function of the amount of energy, that is the amount of machines that we use in the world. And because that energy is mostly fossil fuels, here you find what is the predicament of people that negotiate in climate talks and all the people that are involved in climate issues. It's that basically, for the time being, increasing the GDP means increasing emissions, and there is absolutely no way we can decouple the two, because again, having a larger GDP means using more machines, means using more fossil fuels, because they're the it's the easiest form of energy to use. So fossil fuels put CO2 into the atmosphere as clearing forests. And what you can see on this graph is the consequence of the fact that CO2 is an oxide. As I said, CO2 is an oxide, carbon dioxide. And it happens that on Earth, oxides are very stable molecules. Actually, if you don't give energy, in quotes, to an oxide, it remains forever under the form of an oxide. For example, iron is found on Earth under the form of iron oxide, and it's been iron oxide for hundreds of millions of years, since there is oxygen in the atmosphere, actually. This means that once we stop emissions, there is no way that we can remove fast the surplus of CO2 that we have put into the atmosphere. As long as it is in the middle of the atmosphere, actually, nothing happens to that CO2. In order for the CO2 to get removed of the atmosphere, it has to go in contact with the soil. And there, two processes can remove the CO2. The first one is dissolution of CO2 into seawater. It's just CO2 going from one place to another. And actually, it can be reverted. If there is less CO2 into the atmosphere, part of the CO2 that has been put into the ocean will pop up and go back into the atmosphere. The other process is photosynthesis, needs a photon, needs energy, and it puts CO2 under the form of carbon into plants, but that is also reversible because plants can burn, they can die, and then the carbon goes back into the atmosphere. Because of the fact that the removal of CO2 is a slow process and that CO2 is a stable molecule, it means that the day we stop emissions, of course, we will not find the concentration of CO2 that we had in the atmosphere before the industrial era overnight. Actually, what this graph says is that the day we stop emissions, we have to wait for a century for the surplus of CO2 into the air to be divided by 2. After 1,000 years, 20% of the surplus that we have built up is still there. And after 10,000 years, 10 to 20% of the surplus will still be here. It means that there is absolutely no way to put the climate system back into its original state until you die, or your kids die, or the kids of your kids die, or etc. Actually, for historical times, meaning a couple centuries or even a couple millennia, the climate system will never go back into the state that it was in before the industrial era. It's another way to say that the climate of the year 2000 is gone forever for historical times. And of course, this is a big issue for our civilization, because we have taken the habit of managing everything with very, very short scales of time. For example, an electoral mandate is a couple of years. And of course, for people working in the financial world, sometimes a long-term strategy is 3 months. So this is a very big issue regarding what we have to address, because we're looking at something that has to be managed over the course of centuries. One of the consequences of that very long lifetime of CO2 into the atmosphere is that the temperature increase, which is the main marker, I would say, of the climate change, of climate disruption, is something which is very slow to react to a change in emissions. What you see here is the difference of average temperature on Earth compared to 1850 over time. You see that for a century, actually, the average temperature didn't change. Then over the course of the 20th century, it grew by 1 degree, roughly. And what you can see is that whatever we do regarding emissions, all these are various emission scenarios, for the 20 years to come, what is going to happen doesn't depend on the emission scenario. In other words, because of the tremendous inertia of CO2 into the air, whatever we do from now, the climate system of the 20 years to come is going to change, and it doesn't depend on our future emissions. It all depends on the past emissions. So we cannot change anything to this. And what this graph says is that the 2 degrees, we're going to get them whatever we do. In order to know whether it's a big issue or not to gain a couple of degrees, I will now compare Europe of present times and Europe of the remote past. Here you have Europe of present times, or rather Europe of the 20th century, and it's with the kind of ecosystems that you find if we don't clear them to make way for agriculture, infrastructure, etc. So basically in Europe you have forests, which means that it's mild enough and humid enough to have big vegetal species. Here you have the state of Europe 20,000 years ago, because in the course of natural climate changes, natural climate variation, during the Quaternary era, we had glacial ice ages and mild periods, just like the one that we have experienced for the last 10,000 years. So 20,000 years ago, what you can see is that the state of Europe is much different from what we have today. First, there is no Norwegian sovereign fund because there are no Norwegians. They're under the ice. And there is no Caisse des Jardins because they are also under the ice in Quebec. All Canada is covered by ice. All Scandinavia is covered by ice. All the Scots are covered by ice. And because this ice has taken so much water from the ocean to build up, the level of the ocean is 120 meters lower. So you have no fiscal heaven in the channel because you have no channel. What you can see is as the climate is much colder, it is much drier, and therefore the ecosystems that you have in Europe then were much poorer than those that we get today. And basically, France looked like the northern part of Siberia today at the time. And in that ecosystem, France could feed 100,000 men, roughly. That is the size of a small city. When Europe went from that state to that state, obviously it happened in the course of a global warming regarding Earth. Well, that global warming represents 5 degrees in 10,000 years. So here you have the consequence of a real-time or real experiment, which consists in warming the Earth by 5 degrees in 10,000 years. And you can see the change that derives from that increase. So what you can keep in mind from now on is that a couple degree of increase of the average temperature is going to trigger massive turmoil because it's going to change everything everywhere at a speed that we won't be able to cope in a world remaining stable. A couple of consequences that we are going to get. Here you can see a number of consequences that we will get, and with the magnitude of the change depending on the temperature increase. Something that you should not keep in mind or remove from your mind if you already had it is that the consequences are not a linear function of the temperature increase, meaning a temperature increase of 2 degrees is not 2 times as bad as a temperature increase of 1 degree. It might be 100 times as bad or 1,000 times as bad and not at all 2 times as bad. When you hit the purple here, it means that consequences become widespread and irreversible. What you can see is that on the right part of that slide, you can see that at 2.5 or 3 degrees, you begin to have instability, widespread instability due to lack of food. Basically, that's what it means. So you will have instabilities, political instabilities everywhere on Earth, right, starting at 2.5 or 3 degrees. And of course, if you have this kind of instability everywhere on Earth, it means that stability point period will be, of course, gone in a large fraction for a large fraction of humanity. If we want to avoid these consequences, here is an idea of what is at stake. These curves represent the temperature increase that you get for the climate system depending on the cumulated emissions that we will put into the atmosphere from the beginning of the industrial era until 2100. So basically, you look at all the CO2 that will pour into the atmosphere here, and this line will give you the magnitude of the temperature increase that we will get for the same period. So at the end of 2018, I don't have the figures for 2019 so far, humanity has poured a little bit more than 2,000 gigatons of CO2, billion tons of CO2 into the atmosphere, 2,200 to be precise, according to my calculations, which means that if we stop right now, we will get 1.5 degree, and if we emit a little bit more than 0, we will get 2, as I explained before. If we want to stick to 2 degrees, then we're entitled to emitting 3,000 billion tons of CO2, of which 2,200 have already been emitted, meaning that emissions should be divided by 3 worldwide in the course of the 30 years to come. A division by 3 in 30 years means that the emissions have to decrease by 4% per year, each year, starting now for the 30 years to come. Now, a link with what is happening today is going to illustrate what it means. The COVID episode is probably going to trigger a 6 to 8% decrease of the CO2 emissions in 2020. It means that in order to meet the 2-degree target, we should have an extra COVID episode. I really mean an extra COVID episode every 2 years. So after the COVID, the GDP remains where it is. Then in 2 years, we get a new COVID, and again, 8% decrease, etc. So now you understand that being aligned with 2 degrees is something that means that actually you're a company that can resist in a world where you have this kind of accident every 2 years. That's what it means, actually. So to conclude this short presentation, today we have 2 types of risks that we can face when we look at climate issues. The first risk is having climate damages that increase too much and that will get out of control compared to what we can handle. And the symmetric risk is to want to decrease emissions so quickly that because all our industrial world relies on fossil fuels, and it will disrupt basically all the economic systems that we have built, because the rate of the decrease in order to meet stringent targets is so fast that it's going to create so-called transition risks. That is the risk which are induced by the transition itself. And now I hand over to either Marianne or Jean-Yves.
Thank you, Jean-Marc. Can I share my screen now? Maybe Alexia, you need to set me as a presenter. Do you see my screen?
Yes.
Perfect. So hello everyone, I am Jean-Yves Wilmotte, working at Carbon4 and leading the finance practice at Carbon4 consulting side. Maybe if you don't know the Carbon4 galaxy or the Carbon4 group, there are 2 entities, Carbon4, the consulting side, the historical part of Carbon4, and Carbon4 Finance is a data provider dedicated to the financial sectors. And in fact, it's bringing all the expertise that we have learned at Carbon4 Consulting, working with corporates. So all this expertise of more than 10 and now 13 years of expertise to the financial sector. So what we do is we analyze the portfolio, as Jean-Marc said, based on physics. So how to measure this risk? So Jean-Marc said there are 2 main types of risk: the transition risk and the physical risk. And actually, it is the risks that the TCFD asked to report on. So if you don't know the TCFD, it is now the most common framework used by financial actors to assess and disclose their risk and climate stakes. So we developed 2 offers for financial actors to measure and to assess this risk. One is called Carbon Impact Analytics, to measure the transition risk, and the other one is called Climate Risk Impact Screening, to measure the physical risk. So I'm in charge of the Carbon Impact Analytics methodology, and I will give you an overview of what we do with these 2 methodologies today. When I say we address both risk, we also address all asset classes, because all these asset classes can be subjected to this risk. So of course, the listed equity, the bonds for corporates, the sovereign bonds, but actually infrastructure is also an asset class that is very exposed to both transition and physical risk. And unlisted assets. So we developed common methodologies to be able to assess and to implement strategies, so linked to the risk management, the climate risk management into the portfolios. How we do that, in fact, we will score the main outcome of this methodology will be scoring the risk. What we don't do today is provide financial metrics, because it's impossible to say what will be the financial loss for a portfolio linked to this post risk, because it depends on the scenario and it will depend on a lot of assumptions, and will lead to a lot of uncertainties. But what we can deduct from physics is what will be the relative vulnerability of companies related to this risk, by identifying the main risk factors for each type of risk, and to assess what's the position of different companies relative to these risk factors, and relatively rank companies which are the more at risk and which are more exposed to opportunities. So that's what we do. We can deduct from physics, say this company A is less exposed to climate risk than company B. Let's start with carbon impact analytics a bit deeper. So the main risk factors for the transition risk is the greenhouse gases emissions, because we need to reduce these emissions, and not all companies are prepared for this transition. And this is the definition of the transition risk. Here is just an example of a 1.5 scenario for the European Union. So it's a scenario made by the European Commission, and we won't discuss the assumptions here. I just wanted to show you that all sectors will be impacted by this transition. And so, of course, the energy production will be impacted, but also the energy demand, and all sectors will have impact. All sectors will have transition risk. And that is at sector level, but if you look at a company, in fact, you need to assess it at the value chain. I can take an example, for example, an automotive manufacturer, a car manufacturer. If you look at its greenhouse gases emissions, the direct greenhouse gases emissions will be linked to its energy consumption and then the factories of this company. But its risk, it's more based on what it needs to build a car. For example, the production of steel, so the extraction, the processing, the transportation of the steel, the plastics, and all the materials of the vehicles, and the use of the car, of course. And the transition risk for a car manufacturer is much more linked to the performance of the car, to the weight of the car, than the factory itself. So we need to assess the greenhouse gases on the whole value chain of car manufacturers. Another example is the food industry. The food companies will have direct greenhouse gases emissions, but most of the emissions will come from the upstream, so the crops or for example, the cows. So you can go vegan if you want to lower your footprints. And the downstream side, so the retail and the cold chain, for example. And so the transition risk will most of the time be hidden in the suppliers or the clients of companies. Problem with that is if you look at the reported emissions in the annual report, you will find the direct emissions, what we call the scope 1 and 2 in carbon accounting methodologies. What we need is to have the scope 3 emissions, both upstream and downstream. And that's what we do at Carbon for Finance, is to recalculate these emissions to be able to provide to investors and banks the whole value chain and the whole risk, all transition risk on the value chain. So this is a small illustration of the carbon accounting scope, and the factories are the scope 1 and 2, so the direct and emissions linked to the electricity consumption, and both upstream and downstream emissions will be called the scope 3. That's what we do. If you think risk, you need also to focus on opportunities, because some companies may have a high carbon footprint, but may be part of the transition by, for example, manufacturing efficient products or provide efficient services. So this kind of companies will benefit from the transition. It's more an opportunity than a risk. So we need to assess that also on top of the risk. Also, companies that are able to reduce their own carbon intensity and so be on track with 2-degree alignment, for example. This represents opportunities for these kind of companies. So we assess these opportunities with an indicator called the emission savings. And if I take a small example of what we provide, if we compare an oil and gas producer, company A, and an insulation material manufacturer, company B, that product insulation materials for buildings. If you look only at the reported figure in the annual reports, you will deduct that the company B has more emissions in terms of ton of CO2 per million euro revenues. So it may be more at risk regarding the low carbon transition. What we do is to add scope 3 emissions, and for the oil and gas company, it will be the emissions related to the use of the fuels produced by this company. It's at the client side, but still it's a large part of their emissions. For company B, the scope 3 will be very small. So you can see that the order of merit is the opposite. And on top of that, we'll add the fact that the company B will help their client to reduce their energy consumption and their carbon footprint. So we'll assess the avoided emissions due to the insulation materials. And that is for us the true climate performance, the true climate risks and opportunities for this company A and company B. We complete that with also a forward-looking analysis, but I don't have the time to go into detail. And this brings to a scoring of the transition risk from A to E. And so in companies within the same sectors, the physics can tell us which companies will benefit from the transition and what are the companies that will not be able to decrease their emissions quickly enough to be on track with scenarios. So they will have to pay carbon tax, to lose markets, and maybe to go bankrupt if they don't change quickly. Maybe a small time regarding the news at the European Commission, because you may have heard about the EU taxonomy, also a green bond standard, and the definition of climate benchmarks. So the European Commission has an action plan regarding sustainable finance, and they build a technical expert group. So I'm part of it. I don't have the time to explain all the EU taxonomy, but just the main difference between what it gives and what enable or methodology. So it's in the use of this metrics. The green taxonomy will enable you to identify activities that are green and those that are not with a threshold. So at activity level, it's green or not, and at company level, you will have the share of turnover, which will be green. What we do is to be able to provide a score from A to E. And so if you need, for example, to reallocate your capital, you need to know what is green, but also what is brown, and to decrease the brown part and the risk side of it. So the EU taxonomy only assess for what we could call the opportunity, but not for the risk side. So that's the main difference in the use of these two tools that are complementary. CIA also provide a green share, and we are aligning our green share with the EU taxonomy. But on top of that, we need to calculate the emissions because it's more granular, the analysis. I also wanted to mention that the climate benchmarks that are determined by the European Commission. So two types of benchmarks that need to drive, for example, passive investment into the path of the Paris Agreement. They have minimum requirement. I will only insist on one, or maybe on two. First one is that it needs to integrate Scope 3 data. So it means that all data is already compliant to build this kind of data and this kind of index. Second thing is that 7% reduction of GHG intensity is needed because it aims to align this benchmark with a 1.5 scenario. So it's very ambitious, and it gives the ambition of such a scenario. So Jean-Marc said it's -4% for a 2-degree scenario. It's -7% for a 1.5 scenario. And regarding physical risk, just a word on it, we assess that by looking at the sectoral vulnerability of companies. So depending on what they do, they are exposed or not to hazard. And we look at the projection of climate hazard. So climate hazard is, for example, the temperature, the floods, all the physical risk, all the physical hazard. And this depends on the location of the assets. So having the location of the assets and the sectoral activity, we are able to calculate the climate risk. And in a sector, for example, identify which companies are more at physical risk than others. I will leave the floor to my colleague, Marianne, and thank you for your attention.
Yes, we wanted to give you 2 examples of how you can use our data. So the first one is the green weighting factor. So we had the investment banking arm of Natixis to develop this green weighting factor. Natixis' objective was to set its financing activity on a trajectory consistent with the objective of the Paris Agreement. So how does it work exactly? The green weighting factor allocates capital to financing deals based on their climate impact. It is based on a highly detailed sector-based methodology developed by Carbon4 and Carbon4 Finance data, whereby each financing transaction is assigned an environmental rating on a 7-level color scale from dark green to dark brown, so a scale from 1 to 7. This rating is calculated from an assessment of the deal's climate impact and other factors, including water, pollution, waste, and biodiversity. And under this mechanism, analytical risk-weighted assets, so for the bankers, you know what we're talking about, it's the core indicator for a bank. So the risk-weighted assets are reduced by up to 50% for green deals, while facilities that have a negative climate impact see their analytical risk-weighted assets increased by up to 24%. So this provides a very strong incentive for Natixis teams, like financing teams, senior banker teams, and credit team to favor green financing when assessing this with equivalent credit risk. So we remain at your disposal if you want to have more information on how to assess a credit portfolio for investment banks or for real estate portfolio or credit portfolio. But it's very interesting to have this example because it touches the core activity of a bank. The second example, Jean-Yves, if you can move to the next slide, it's the Euronext Low Carbon 100 Index. Euronext was the first stock exchange operator to launch a European CO2 emission index in 2008. The index is composed of 100 European companies selected as they are considered best placed in relation to the climate transition compared to other companies. And in 2015, Euronext partnered with Carbon4 to renew the methodology. And the new version of the index is based on a more in-depth assessment of the carbon footprint of each company, assessed across the entire value chain, as explained by Jean-Yves. The identification of the companies which are making a positive contribution to the climate transition. And the selection of companies takes into account the level of emission avoided thanks to their efforts to innovate products and services. The Low Carbon Index 100 was the first in the world built to reflect an investment trajectory compatible with the 2 degrees pathway. So now there's the new climate benchmark communicated by the European Commission, but Euronext was the first to think about that, and we can see that on the graph that the Low Carbon 100 and the ETF built by BNP Paribas Asset Management are very well performed considering the current health crisis, and more generally, since 2008, the performance of this index has been far superior to that of many European indices which do not have this low carbon filter. So that proves that if you invest in the right companies who has an impact on the climate transition, you do have a performance in your portfolio. So I guess we have some questions here. I think that's maybe one for Jean-Yves is where do we get the data to aggregate the metrics that we were talking about? Jean-Yves, are you back?
Yes.
Maybe you want to...
Yes, you hear me?
Yes.
I'm back. So where do we find the data? In fact, in the annual report, of company, the CSR report, we find all the activity data we need to recalculate the scope 1, 2, and 3 emissions and the emission savings.
And can you explain a little bit more how we construct the forward-looking approach, the sub-criteria?
Yes, so the forward-looking is based on 3 sub-criteria. So the company strategy regarding the climate change, to it claim to change its business model, to have a very decarbonizing strategy. to have low carbon products, for example, to go to this kind of market. Secondly, the investments to the company as investments in low carbon project or research and development. And third, the targets. The company have ambitious emission reduction targets. So that is the core of our forward-looking analysis. For each sectors, we have a framework telling us what is a good company and what is a bad company for this sub-indicators.
And there was a question about Total and Shell and some other oil and gas companies who announced they wanted to be carbon neutral by 2050. I guess we need a little bit more details on that. Jean-Marc or Jean-Yves, do you want to have a reaction and to talk about our net zero initiative, maybe?
Yes, I've just posted the link actually to the webpage of the Carbon4 website, where we have released a couple of weeks ago the guidelines on neutrality, which bears the name Net Zero Initiative. Actually, what we have said in one sentence is that the company cannot be neutral on its own. So basically, that's the consequence. All that a company can do, because it's part of an ecosystem that goes to the whole world, is contribute to the global neutrality. What makes sense is neutrality at the global scale, meaning that at some point in history, we will have to balance global emissions with global sinks, because as long as we do not balance the two, we add up, we build up CO2 into the atmosphere. And that global neutrality will happen anyway someday, because fossil fuels can be depleted. What doesn't make sense is to isolate a single company and say, I can become neutral on my own, whatever the rest of the world does. Doesn't make sense for us. And we have published a full referential on full guideline, sorry, on that, and I've posted the link to these guidelines. So Total cannot be neutral.
Yes,
as any other company.
And in this target, it only concerns the scope 1 and 2 emissions. So the scope 3, the use of the fossil fuels, is totally not addressed in this target. So it missed the whole and the largest part of it. Secondly, also this principle of net zero initiative will also introduce it into carbon impact analytics in the coming year. So we'll also have the triple accountability principle that is proposed by the net zero initiative.
I think, Jean-Marc, there's a question for you. It seems impossible to reach a 2-degree pathway. How do you help companies to adapt to
that? Actually, the way we have designed the method so far is assuming that it is possible. And we have done so because we have based our approach on a scenario that is published by the International Energy Agency. Because when we developed carbon impact analytics, we believe that nobody would give credit to a scenario, an in-house scenario developed by Carbon4. So we based all our metrics on a scenario that was published by the International Energy Agency that considers that absolute decoupling can happen and that we can achieve 2 degrees in a world where we do not constrain the economy too much. So the metrics that we publish today are based on this scenario that we do not believe is physically credible, actually. But of course, if we remove that scenario and replace it by another scenario, which is more realistic according to us, chances are that there are not many companies in the world that will turn out to be 2-degree compatible, because basically a 2-degree compatible company is a company that can cope with a global decrease of the world emissions of 4% per year. So witnessing what it means today, one can easily understand that there are not that many companies that correspond to that definition. But it doesn't mean that what we label 2 degree today has no meaning, because actually what we do is ranking activities and companies, and it's the relative, I would say, the relative vulnerability, which is interesting today. Because as long as the economy doesn't stop, the issue is stated in relative terms and not in absolute terms.
There was another question. Is it possible to test one of our portfolio? Well, definitely. Myself and Jean-Yves, we are at your disposal if you want to organize a call to explain more of the methodology and how we can apply to your business model. We can look at your sample portfolio and try to see to give you an example of our data and talk you through how to use that in your risk management or portfolio allocation or whatever might be your business model. So the performance of the index, yeah, you don't have a lot of historical on this on just the last 3 years, but 2 years. But globally, the index overperformed the benchmark for many years now. It resists to most of the downfalls, especially in 2008 or 2011. There was already a very good resilience of the index. So throughout of time, we can say that it has always been above the benchmarks. Doesn't have much to do with oil prices because there's no exclusion in this index, or maybe coal manufacturer maybe because they can't be in 2 degrees world. But in terms of oil pricing, I'm not sure it's relevant to this analysis. Maybe I'm wrong, so I'll let the expert talk. Jean-Marc, why governments don't use our tools?
Well, we hope they will. Actually, they can indirectly use our tools because, as you probably know, for a number of you, in France, we have that Article 173 regulation, which says that people that work in the finance industry have the obligation to publish something about the way they address climate issues. And one of the ways to do so is to use our data. We believe that what the best that can be done with what we do goes far beyond coping with this kind of regulation, which is a soft regulation so far. But it's one of I would say that there is a little something of public use of our data in this kind of application.
Actually, Agence des Participations de l'État, which is the French state as a shareholder, is using our data to assess its own portfolio. So it's kind of the government, the state, the Ministry of Finance using our tool.
Well, there's a lot of questions. I'm not sure we can address all of them because that's the end of the webinar. Alexia, what do you think? We take more questions? Do we have time?
We can take a couple more, and anyway, people have to go. They will find the answer on the video that will be posted on our website. So.
There is a question for the retail banks. So today we apply CRIS, so the physical risk.
5 more minutes.
Just we can add 1 or 2 questions extra.
So for the retail banks, we applied CRIS, the physical risk methodology, to mortgage and real estate portfolio for our retail banks. So that's an application. It's also possible to calculate the emissions, so the CRIS methodology to retail banks.
There's another one. Low carbon index seems to outperform. How do you explain the market has not totally turned towards low carbon? Well, to be honest, our objective is to convince asset manager, banks and asset owners that they need to include climate risk assessment into their decision-making process, into their asset management tools, because now it's not only a question of looking at the financials of a corporate to see if you want to include that in your portfolio, but you need to have also this forward-looking view. And with climate risk data, you can have this resilience that we were talking about, and include our data in your decision process will be a change of paradigm for you, because they will bring you more resilience and more performance in the future. So we're true believer of that, and we have more and more asset managers and banks calling us to include that. So it's a structuring project for them, but I think it's very interesting to participate in these initiatives, because that's how we will go to change the mindset of everyone.
There is a question on carbon taxes that I would like to answer. Actually, the implementing a carbon tax is far from being the main transition risk. Actually, the main transition risk, in our opinion, are regulation risks. So that, for example, overnight you forbid this or that. Today, for example, you have an example of a transition risk, not for climate issues, but for sanitary issues. And you see very well how the situation can evolve overnight from a stable state to something very different. Our belief is that the risk for transition risk and physical risk are going to materialize much more in the form of going down a step than in the form of slowly increasing carbon tax that will smoothly allow everyone to evolve very smoothly also. There are a couple of sectors in which it's not true, like, for example, power, but in most sectors, it's not carbon tax which is to be feared, much more regulations. One last question, Marianne? Or?
I think well.
Oh, it's over.
Okay, I think we could. Well, thanks you all for joining the webinar. I hope you had some interesting topic and answers your questions. And we're happy to connect with you if you want to move forward and have more detailed information about our methodology and our database.
Thank you.
Okay.
Thank you.
Thank you very much. Bye-bye.
Bye-bye.